Hi everyone, welcome to our March market recap. Before I get started, I want to give a warm welcome to the new clients that are joining us through the Waypoint Financial Advisors merger. I know everyone here at Soundview is very excited to have you here, and I'm looking forward to getting to know all of you and supporting you and helping you feel more confident about your financial life and your investment strategy. And for all of our clients, for both longtime Soundview clients and those joining us through Waypoint, I want to share a quick market update, a recap of March, and a little bit of perspective on what we're seeing right now. March was a really good reminder of how quickly markets can move when headlines take over. We saw a lot of pressure across stocks as investors weighed geopolitical tension, rising oil prices, and higher bond yields. They also had concerns about inflation and growth. It was a very volatile month. And even though the markets rebounded strongly on the final trading day of March, the bigger takeaway is simple. Short-term news can move prices very quickly. And that's why I think one of the most helpful ideas for investors right now is the difference between an event and a trend. An event is something sudden that grabs attention, it moves markets in the short term. A geopolitical conflict is an event. A spike in oil prices is an event. A surprising inflation report is an event. A very scary headline is an event. Now, these things matter, and they can absolutely create volatility, but a trend is different. A trend is a bigger force underneath the headlines. So think of things like long-term economic growth, innovation, corporate earnings, demographic shifts, population changes, consumer behavior, and the value of staying invested over time are these trends. So while markets will react quickly to events and sharply, they tend to be driven over time by trends. So that matters because one of the biggest mistakes that investors can make is treating a short-term event like a permanent change to their long-term plan. I saw this when people took all their money and put it in cash in 2009 and waited to get back in the market. And then years later, they wondered why they didn't have as much money as their friends because they never went back in. We've definitely seen this before. And every period of market stress feels unique in the moment. But if you step back and look at market history, investors have lived through wars, recessions, inflation shocks, market crashes, banking scares, and even a global pandemic. These events are real. They're unsettling. They can be devastating and tragic. And in many cases, they cause meaningful short-term declines. But over time, markets digest those shocks and move forward. That doesn't mean volatility feels good. Trust me, it was the last month where I was working with Alan and we were watching every day. And, we know that it doesn't necessarily, markets don't necessarily move straight up. They don't. It just simply means that volatility is a part of long-term investing. And that is especially important to remember during pullbacks. When markets fall, it can feel like something is broken. But pullbacks happen regularly, even in years where the market finishes higher. And volatility is not a sign that your plan has failed. In many cases, it's simply part of the price of being invested. And that's why discipline matters so much. When fear rises, and we are in an extreme fear state, the most tempting thought is often, maybe I should just move to cash until things calm down. And that reaction is totally understandable. It feels safer in the moment, but historically, moving to cash during periods of stress, like I mentioned before, creates a second problem. And that is, when do you get back in? Because the market doesn't send an invitation when it is time to recover. And some of the strongest market days often happen very close to some of the weakest ones, sometimes the next day. And if you step out of the market at the wrong time, you can lock in losses and miss the rebound. That is one reason that we focus so much here on planning, asset allocation, and diversification instead of prediction. So diversification doesn't mean every part of your portfolio is going to be up all the time. The point is kind of that it's not. It means that we're not relying on one single market segment, one headline. or one outcome when it comes to the whole plan, when it comes to the big picture. So this is a way to build resilience. And if we look at things right now, resilience really, really matters. So we're also seeing an economy with mixed signals, which is another reason not to overreact to any one headline. So inflation is still part of the conversation, definitely. When energy prices move higher, but it's not the whole part of the economic story, because there's some areas that are cooling while other places rise. And one of those areas I've been watching is housing and labor trends. Consumer demand is also another, as well as energy prices. They can all move in different directions at the same time. And that's why broad narratives can sometimes be very misleading. And beyond the headlines, there's usually bigger structural trends that are worth watching. So this can mean things like demographic shifts. As more people move into retirement years, these longer term changes are going to affect the labor supply. They're going to impact consumer spending and how money starts to move through the economy and the market over time. Now, we've also seen how dramatic the daily market can be in this environment. There have already been multiple 1,000-point up days and multiple 1,000-point down days in the Dow during this administration. And that is a really good reminder that headline point moves can sound incredibly dramatic, and markets can swing really sharply in both directions. And so reacting emotionally to any one day is usually not a sound long-term strategy. So what do investors do with all of this? First, I think it's really important to remember that uncertainty is normal. And second, really stay focused on your plan. Third, make sure that your portfolio still reflects your goals. And we'll talk about this the next time we meet. We'll look at your goals. We'll look at your risk tolerance, your timeline, if things are changing at work, if there's offshoring, if your income needs change, or if you're retired or approaching retirement. This is especially important to always reevaluate. And finally, it's really important not to let a short-term event push you into a long-term mistake. And honestly, I was thinking about this recently in a completely different context. So I ordered couches from Jordan's Furniture in the month of February. I also went to the University of Connecticut, and they had a promotion that said that if the men and the women's basketball team both made the championship game for NCAA basketball, that your furniture would be free. So, of course, I wanted couches, I will say. My kids are teenagers, my dog is 100 pounds, and so I started playing, and I always pay pretty close attention to basketball in March. So when I look at UConn, the loss we had to St. John's, that's an event. And that might make you think, don't bet on UConn this year. But UConn winning in March is a trend. And this is the point. If we focus too much on one disappointing event, we can lose sight of the bigger pattern. So that happens in investing, and it happens all the time. So when we think of scary headlines and we think of a rough market day or a sharp sell-off, or you see the headlines, and that can make you question everything, even when the longer term trend is still the most important story. So that's really the heart of today's message, is to know that events create noise, trends create outcomes. And hopefully my couches will be free soon and UConn wins tonight and tomorrow, but we'll see. If you're a new client just joining us, welcome again. So excited to have you with us. And for all of our clients here, if recent market volatility has made you rethink things, if there's been changes or questions, whether it's about retirement, whether it's about your income, your risk tolerance, or how your plan is positioned, please reach out. We are definitely here to help. And we'll continue having these conversations all year long. And we're really, really happy to walk through whatever matters to the most of you here. So thank you again for watching, and we'll talk again next month.